So we just had our spring statement. This was Rachel Reeves's chance to update us on the state of the economy. This wasn't a budget. They were keen to point out this is a statement, although it had elements of a budget to it. But the idea is that the autumn budget will be a larger fiscal event, and these statements will be smaller. And this certainly was smaller. So here's all the things that I caught from that statement, so you don't have to listen to it. So the deficit there's going to be a deficit of 4.1 billion by 2029-30. It was forecast to be 9.9 billion in surplus in the autumn budget. So it's been a pretty decent sized reversal there. And basically missed because of rises in what it costs for the government to borrow money. So essentially this was a repair job to get essentially 14-15 billion and get us back into surplus. So net debt was forecast to be 82.9% of GDP by 25-26, 83.5% the year after that, and 82.7% by the end of the decade. So yes, circa 15.1 billion of headroom by the end of this decade is our total. So there's going to be a further crackdown on tax evasion. The Chancellor thinks and says that the OBR thinks that this will raise around 7.5 billion in total. So it's about another 5 to sort of 750 million going on the previously announced figure. And if you can work, you should, and if you can't, you should be supported. There was a message from the statement. The UC allowance is raising from £92 per week to 106. That's pared back slightly from £107 per week. The health element will be cut by 50% and frozen for new claimants. They reckon this will deliver savings of around 3.4 billion. They officially announced the abolishment of NHS England. This is part of a larger work to reduce the costs of running government. They think that they can reduce these costs by about 15%, which should save about £2 billion by the end of the decade. 3.25 billion of investment in public sector reform. This is some voluntary exit schemes for people in the civil service, some spending on AI tools, technology, probation services, supporting children in foster care. They reckon this will deliver about 3.5 billion in savings by the end of the decade, so more than the initial investment. Labour and the OBR thinks that the changes to planning will drive house building to 40-year highs. This will allow 1.3 million homes to be built in the next 5 years, and to support this, they're going to spend about 600 million training up 60,000 more construction workers, including introducing 10 new technical excellence colleges. There was a big announcement to defence spending. So there was a boost to defence spending and a cut to foreign aid spending. Defence spending is going to go to 2.5% of GDP. Foreign aid is going to go down to 0.3% of GDP, which is about 2.6 billion saving by the end of the decade. Amounts to about 2.2 billion boost in defence spending, 10% going into new technologies like drones and AI-enabled tech. Glasgow, Derby and Newport will see advanced production jobs in defence. They said this would help the country feel the benefits. And they're also investing into Barrow, which is where our nuclear submarines are maintained. The OBR revised growth down from 2% to 1%, slightly rosier than the BOE's 0.7%, but not good news in any way, shape or form. Capital spending up by 2 billion. They reckon we'll be at 2% inflation by 2027. And the OBR confirmed that these planning reforms will increase the level of real GDP by about 0.2% by the end of the decade, which is about 6.8 billion to the economy, and could be as high as 0.4% over the next 10 years. And with that in mind, they upgraded growth next year to 1.9%, the year after to 1.8%, the year after that to 1.7%, and the year after that 1.8% in 2029. And they reckon that should make the average household about £500 better off after inflation by the end of this parliament. So there was nothing in here, and you wouldn't expect there to be anything massively negative because it wasn't supposed to be that kind of budget, Steve. Largely fine is what I would say. I'm not, I wasn't particularly enamoured with the last budget. I thought that was fine, and this is a continuation of fine for me, Steve. What do you think?
I think it's a decent job in some difficult circumstances. That sounds like a sort of backhanded compliment, but there's actually quite a bit in this that I'm reasonably pleased with. Exactly how much of it comes from the previous budget and how much is the adjustments is sort of there to be discussed, but there's some principles here that I quite like. I mean, I've seen both us and the US, and I think when you compare this to what's going on across the Atlantic, I think this compares actually quite well, which is in some ways unusual if you think about where the economy of both of those two countries has been over the last however many years, and that's been kicking through into their respective stock markets. And have a look at some charts, and you'll see what I'm talking about here. But in general, this is quite a it was a fiscally responsible budget, and it's now an adaptation to try and stay within those fiscal rules. And I think it must have been, in some sense, tempting. And I'm not saying how far this is I'm not taking a view on how far this is a politically motivated decision and how far it's out of a sense of duty. But there must have been a temptation here to say, look, things are different to where they were when we set this budget out. Borrowing costs are now a lot higher. Turns out we're not going to be able to stay in within those fiscal rules that we set out. But the Chancellor hasn't done that. She has gone for an approach of sticking to this idea of we need to keep our borrowing in some sense under control and try and balance books. You are seeing similar sounds coming from across the Atlantic, by the way, and it's the first time in either, especially over there, that's been a meaningful discussion in nearly forever. The US has largely been driven by debt and just adding more to it because they are the currency reserve. That said, I'm impressed by the desire to try and stay within. The question then becomes, well, where do you try and make savings from? And it's tricky in some cases here. The kind of headlines that you see it goes less onto, well, essentially benefits both in this country and abroad. Foreign aid budget being reduced was kind of known about or trailed. Our local MP is Annalise Dodds, who stood down from the cabinet as a result of disapproving of foreign aid changes. Increase in defence spending is also quite interesting to me for reasons I'll come back to in a different segment on this, but if anyone's watching on YouTube, Britain isn't necessarily a country that needs, as a result of NATO requirements, to lift its defence spending. This is a choice, but it is a decent investment into the things that we actually manufacture and produce pretty much at a world-class level and are capable of still doing. And I kind of like the idea that what this government has done is try to work out what it is that this country does better than anybody, because it isn't have lower costs than everyone else, right? We pay people more than they get paid in China. And that's probably a good thing for any number of reasons, but it does mean that there's lots we can't compete on because we just don't have the cost structure to do it. Defense and defense weapons, military stuff, call it what you like, in all of this. And also things like, there wasn't anything in this statement about it, but the kind of leaning into university level innovation research is an area where the country's strong, and I was good to see focus on that. The growth numbers are interesting sort of to me. It's down to 1% then for the time being, but then we go 1.9, 1.8, 1.7 and 1.8 again, I think, which is okay. I'd be impressed if they can get those growth numbers through without any further kind of borrowing costs rising. I think that would be a good result if they can make that happen. I assume, by the way, I can't see based on what I'm looking at from the BBC, I assume those numbers are real terms growth, because if they're not real terms growth, they're terrible. They're all below inflation. But in this case, both they're mostly being pushed along by inflation, but there is real growth on top of this, which is encouraging to see. There was one thing that I don't think you mentioned, Steve, that I thought, again, stands out to me as a similarity to the US, but a point of contrast, and just the way Britain does at least these things anyway, better. A plan to reduce the administrative costs of government departments by 15% by 2030. What you might call the UK's Department of Government Efficiency, but not being run by someone carrying a fucking chainsaw.
Yeah, I prefer it this way. I think I did post this up on the Trading 212 community, and a civil servant responded to me and said, "This is great. What happens is you basically get a massive payout, and then they employ you on a higher wage to come back and consult for them. So this is like a real win-win for the civil service. So I hope that isn't the case. But yes, there's an accompanying document that comes out with it, and the bit that I suppose people care about the most, or maybe don't care about the most, it depends how you feel. But the government said it's looking at options for reforms to the individual savings accounts that get the balance right between cash and equities to earn better returns for savers, boost the culture of retail investment, and support the growth mission. Alongside this, the government is working closely with the Financial Conduct Authority to deliver a system of targeted support to help give people the confidence to invest. No numbers were given or anything like that. It is simply that they're looking at options. A reminder that your allowances this tax year are ISA 20,000, stocks and shares ISA 20,000. They share that allowance with a lifetime ISA, which you can put £4,000 in. That has some more stipulations to it that you would need to look into, and a junior ISA that you can also put £9,000 into for your kids. So yeah, it was fine, Steve. I think realistically, I was saying to people on the Trading 212 forum, you don't have to like the government, you have to like the people running it, but you have to kind of hope that they succeed, because if they succeed, we should all be better off because of it. So at the very least, you've got to kind of go fingers crossed, even if you think that what they're doing is the wrong thing. Fingers crossed that you're wrong and they're right, and we do get some decent growth, because I think we do need it pretty direly, Steve.
Yeah, agree with that. I don't have much of a view on the people in the current government, to be honest with you. I tend to not have too much of a view on them in general, but I quite like the idea of trying to be responsible. Certainly, various different parties have kind of attempted to preach that, and I sort of feel like sooner or later borrowing costs have to catch up to. I feel like they have to catch up to the states as well, and maybe we're seeing a bit of that. But they are attempting to get their deficit and their government spending under control, and I'm pleased enough with the idea that the UK is going to do it. And like I say, my main takeaway there was I like the fact the Chancellor is sticking to her plan here. I feel like there was an opportunity for an excuse offered here, and she didn't take it. I mean, it may well have been politically unwise in such a short space of time to then say, okay, that thing that was non-negotiable before, stuff changed and it became negotiable. Nothing's ever really non-negotiable, right? If we literally went to war, we wouldn't start caring about deficits anymore. We'd start caring about military spending a lot more than we currently do. So these things are always negotiable, at least in some sense, regardless of what any politician on any side says. But I was pleased that Rachel Reeves didn't attempt to take the kind of easy-ish way out there. Should we push on to the next thing?
Just before we do, Steve, I'll just point out to people who don't know about this. So total tax take in the UK is probably going to be around 1.5 trillion by the end of this decade, so 2029, 2030. So to leave yourself 14, 15 billion of surplus is essentially 1%. It's not a lot of headroom. It might sound like a massive number to you, but you think about your own bills and things like that. If you were running it as a household, you're saying over the next 5 years, I'm not expecting much more than a 1% increase in where I am. So yes, they need the growth to help them get the surplus, because they don't leave themselves very much wiggle room, and they don't leave themselves very much wiggle room because the UK economy isn't in the best of states.
You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.